Hi guys, my name is Tom. Welcome to this week's video on explaining the term at the money for options contracts. Over the course of weeks and months, we're going to teach different option terms, strategies, and techniques to our viewers. Our ultimate goal is to educate you about the wonderful, highly profitable world of option trading. As always, do not forget to click the link and subscribe to this YouTube channel. You will receive an alert when we post any new content. Please also check out our social media page on Facebook, Instagram, and Twitter, and also our website. So let's jump into this week's topic, which is explaining the term at the money. Before we do that, quick refresher on what are options. Options are contracts that give the bearer the right, but not the obligation to either buy or sell an amount of some underlying asset at a predetermined price, at or before a contract's expiration date. Option contracts are financial agreements between two parties to facilitate a potential transaction on an underlying security at a set price called strike price prior to an expiration date. When you buy an option contract, you can choose to either exercise your option contract on or before the expiration date, or simply allow the option to expire unexercised. Options are an example of a derivative. A derivative's price is dependent on or derived from the price of something else. Wine is a derivative of grapes. Fruit juice is a derivative of the underlying fruit. Options contracts are a derivative of stocks. One option called a contract, and each contract represents 100 shares. So now that we've gone a quick refresher on what are options, let's discuss the term at the money. So previously we discussed in the money and out of the money. In option contract, which focus on the underlying strike price of the option contract relative to the current market value of the stock. In the money, it's worth something. Depending on if you buy a call or a put, it could be above or below the strike price, but if it was to be exercised right now, it's worth something. Out of the money, could be above or below, depending on its call or put, but if it was to be exercised right now, it's worthless. It has no value. So what does at the money mean? Well, at the money is a situation where the option strike price is identical to the price of the underlying security. Both call and put can be simultaneously at the money. The money option has no intrinsic value, but they still have time value. An at the money option usually costs more than an out of the money option because they are closer to profiting in time remaining until expiration. And at the money are more, they're looked at as more attractive because they are closer to profiting in the time frame. And at the money options are more attractive when traders expect a large movement in the stock. So what you can do if you're an option trader, you can buy it deep in the money, higher chance that you're going to make money, but it's going to cost you more. Out of the money, lesser chance you're going to make money, but it's cheaper. Or you can do an at the money, which you're like, I expect there's going to be a large price movement, but you don't have to pay the high premium of it. So if you're very confident on your research and you really understand there's going to be a large price movement, why pay extra for it? Pay a cheaper price and then get increase that rate of return. You also might hear when you're doing option trading the term near the money. So near the money, or sometimes you used to describe an option which is 50 cents of being at the money. Depending on the intervals and the price of the underlying stock, the intervals might be quite large. So you might not have an interval that's at the current stock price. Therefore, it's near the money. Investors will call this at the money. If it's at $50.50 and the stock is trading at $50, it's said to be near at the money. This option will be near the money if the underlying stock price was trading below 49 to 50. So that's what near the money means. So let's jump into a brokerage platform and show you an at the money option contract and how it sits in between the in the money and out of the money in the option chain. So we've jumped into our brokerage platform, and what we're looking at now is Amazon, the company. And we're going to look at the at the money option contract. So what I say, at the money option contract is a situation where the option strike price is identical to the price of the underlying security. Now, for them to be absolutely identical is, very, very difficult. So there's a bit of leeway when it's identical. But this is a very, very good example, especially for Amazon. This strike price here is 3400. The underlying stock price is 3401. So I'm going to say these are identical. Over a $3,000 stock, and there's only $1.80 difference. I'm going to say it's identical. So I'd call that at the money. This is a difference between in the money, which is for calls, in the money for puts, out of the money for calls, out of the money puts. Again, in the money has the intrinsic value. Out of the money does not have the intrinsic value. So this one right here is at the money. It is technically $1.80 below the underlying stock price. So therefore, it falls into this column. But it falls in this column by 0.0818. So that's why it has the smallest little bit of intrinsic value. That's why it falls into that column. But why would you buy this? Well, as I said earlier, you are very confident in there's going to be a large price movement. Very confident it's going to move up or down, but you don't want to pay that extra premium. So you're like, okay, well, I think Amazon's going to go up to $4,000. And it's going to be a big price movement. I don't want to buy an out of the money because I don't want to risk it. I want to buy an at the money and we do that instead of paying all this premium you would pay if it was deep into the money. So if you bought it here, you would save yourself all this intrinsic value, which was built into this premium extra paid. So your return on investment is you'd make more money if it goes in the right way. So that is simpler when you hear at the money. Now, other one you might hear, let's look at another one. Higher house. So this quite has larger intervals. And this is not at the money. I don't call this at the money. I call this near the money. So this is a underlying stock price is $59.16. The closest strike price is $55. So this is not at the money. It's $4 away, which is a lot for a $50 stock. I would call this near the money. You also see the intrinsic value is actually quite high, 4.4. That's an example of near the money as compared to before, which was at the money. So now you understand what at the money means. In the money, out of the money, out of the money, at the money. In this case, near the money. Thank you so much for watching our video this week explaining at the money for options. If you like this page, please check out our website and click the link. Please also check out our social media pages and subscribe to this channel. And stay tuned for new content next week. Thank you so much.